Commercial real estate sales dropped to just $26.1 billion in April. Now, that might not seem like a very small number, but in the world of commercial real estate, it is. Hotel deals plunged 52%. Industrial property sales dropped 34%. But that slowdown is creating what many like to call a buyer's market. So which sectors are worth buying right now? Well, let's break it down in today's video. Hey, what's going on, wise investors? As always, Matty A. Welcome back to the channel where we give you tactical, real-world commercial real estate strategies and, of course, some news and updates to help you become that much more dangerous in your real estate investing business. Today, we are breaking down April's sales slump. Who's winning, who's losing, and really where are the opportunities or not? So in today, let's dive into the market update. First and foremost, tracking this data is the closest thing we're going to get to a crystal ball. And as a real estate investor, somebody that is trying to navigate where you're at currently or based on where you want to go, based on your current investment portfolio, where you feel that you've got risk, right? These are things that can help you look around corners or project accordingly to make proactive decisions to protect you, to capture upside. And in April, based on the commercial real estate transaction data, sales fell to $26.1 billion. That really ends what many people are calling this post-tax cut Trump bump, right? Many people heard whispers around what the big spending bill was going to do, specifically a lot of the tax incentives and policy that's going to either help or hurt real estate investors as a whole, and they were calling it the Trump bump. Now, buyers have leverage, and this is something that I think right now you should be taking advantage of if you are somebody who is actively deal hunting. Now, as a full-time commercial real estate investor, right, I'm always looking to buy year-round, and I always say, when somebody's motivation meets my price, that's when we can create a win-win. And right now, you have the motivation for many sellers starting to get a little bit more than it has been, let's say, over the last 24 months. We have seen, obviously, because of interest rates and the inflation, the overall headwinds in our economy, tariffs, some of the global, issues with foreign wars and things that have been going on in global landscape that have really kind of created this interesting dynamic. I've been calling it, this standoff between sellers thinking their properties are worth this much and buyers being willing to pay down here, and this delta kind of creating this stalemate where buyers were either going to need to see something positive that got them off of the fence and or sellers to see some kind of motivation or pain that pushes them to come off of their perch and get a little bit more realistic, maybe on price, or maybe just being a little bit more open-minded to getting creative at the negotiating table to create a win-win, whether that's a seller finance or creative structure on the deal. But right now, because so many people have been kind of waiting around the first half of this year to see what the new administration is going to do with Trump coming in, to see what the Fed is going to do with Powell potentially lowering rates, or as we're seeing right now, holding them steady. And ultimately, how is this going to impact the second half of the year and going into 2026 with everything that we know? Well, this is one of my favorite times to get in and negotiate with sellers. You have less competition, you got more motivation, you have this willingness to come to the table and get creative if they really are motivated to create a win-win. Right now, I am closing on a 100% finance deal with a mobile home park. That is something that I was able to get the seller to get really creative with me on, to create a win for them and to create a win for us, which ultimately I'm getting an amazing deal with very little money out of my pocket that still cash flows and has great upside going forward. Those are deals that are out there right now that I'm seeing, that our Wise Investor Collective students are also starting to see more of in their conversations. And so thinking about what is this data showing us, I wanted to share with you the winners and losers in April's sales report. So you might be able to see where some of this demand that is waning might create some urgency, some more pain, some more distress, maybe some more motivation amongst these sellers or owners in these asset classes to identify where you may be able to lean in a little bit harder in the negotiations when you're posturing during some of those conversations. So what are the losers in this April report? Well, number one, hotels are down 52% year over year. We're seeing travel obviously slow a little bit, international travel down with some of the tensions that are going on globally and internationally. We're also just seeing this shuffling from one administration to the next, and with a lot of the policy, with a lot of the tariffs, right? A lot of people are being a little bit more discerning around their discretionary spending, which immediately, of course, is going to impact hospitality, number one. Now, number two is industrial and warehouse sales are down 34%. These sectors are under pressure right now from tariffs, from inflation, and just from overall softening demand. We saw a lot of industrial get delivered post-pandemic for obvious reasons, but in many markets, those have been overbuilt or over-delivered, now oversupplied, which is cooling off the asking prices, is cooling off the leasing prices, and as we're seeing, is cooling off the overall sales that are transacting in this particular asset class. Now, some of the winners are somewhat interesting. Office, which has been the obvious asset class impacted the most post-pandemic, the sales are up 15% year over year in April. And a big part of this is we're seeing a lot of big corporations and companies requiring back in office work. Remote work is slowly starting to come to an end in particular business models or industries, which is driving a lot of people back into office. We're also seeing office conversions become a lot more popular as those are making more sense to convert and spend dollars there versus building from the ground up. Number two winner in April reports is retail. Retail commercial real estate is up 6%, marking 3 months of back-to-back growth, and still a very strong asset class with demand. Obviously, America being a very consumerist-driven society, even with the shakeup of Amazon, we're still seeing retail assets holding strong and retail demand with tenants holding strong. Next, we have multifamily, Class A up 11% year over year. And these sectors show resilience and steady investor interest all the way from institutional capital to family offices to private equity to, of course, mom and pop investors. So what does this mean for you as an investor? What are some of these takeaways that you should be thinking about? I think just overall, the number one takeaway that you should have in this is that this is a buyer's market. I call it the season of seller finance. But overall, in my opinion, and of course, there's always going to be bullish, markets or subsectors of a market or an asset class that maybe the sellers have more leverage in, and it's a seller's market. But in a macro perspective, this is a buyer's market. Sellers are negotiable. And ultimately, I want you to have the mindset that sellers are negotiable and that you can go to the table with some more creative options that potentially in the past they may have not even entertained. Well, now more sellers are starting to entertain these things. More brokers are starting to communicate that sellers are willing to have some of these discussions that they weren't willing to have when the market was, of course, extremely aggressive and tight and frothy, and therefore it was really challenging for buyers to come to the table and ask for anything because you were going to be in a bidding war and there was extreme competition for many assets. Well, that has flipped. And now you can lock in better pricing, better terms, getting creative. There's a lot of ways that you can put a deal together. And this particular market is the best time to do it while many people are still sitting on the sideline, thinking that the market is going to crash, or they're trying to time something. And ultimately, this is where you can get in and create some major win-wins that allow you to win right out of the gate with your purchases as a buyer. Secondarily, I would say focus on resilient assets, right? Of course, historically, we've seen office, industrial, retail, and multifamily be the main juggernauts in commercial real estate. But there are many subcategories that have trends or positive tailwinds that are ultimately protecting or propelling these asset classes to remain strong with demand because they're insulated and they have great returns that investors see as a stable and safe way of generating the yield and getting the benefits that they're looking to get by investing in commercial real estate. Now, I'd still be very wary of office, even with some of those, trends showing the growth, being that most of these upticks in year-over-year sales in office are being driven at an institutional level. So if you're a mom and pop investor, unless it's something that you know you've got tenants for, or you've got a really good plan for how you're gonna occupy and close those vacancy gaps and generate the returns that you're looking for. Office may be one that I still throw an asterisk next to, but of course multifamily, of course retail. You've got industrial, in my opinion, in certain markets still being very strong. Hotels, I think, are going to have some volatility and some horizontal choppiness over the next few years as some of these economic headwinds get worked through early in this administration's tenure. But overall, I always say there's a bull market in every class set at all times. You just got to find out where that is. And ultimately, it's because you make your money on the buy by negotiating the best deal and mitigating your risk day one. No matter what the market does, you know that you have protected your downside and given yourself some opportunity to capture the upside. And the way that you can do that, right, is to stress test your deals. Model downside scenarios, build in those reserves for rent or vacancy dips, right? Making sure that your assumptions are being conservative, they're not blue sky, and that overall you're just being very diligent in what feels like still some uncertain times ahead. And therefore, we want to model that uncertainty. We want to stress test that in our models to make sure that based on whatever we offer, based on what we end up closing at, that we have taken into account all the best and worst case scenarios and protected and planned for those in our model. And last, I would say, is deploy your capital strategically, right? Private funds are stepping into bank retreat zones, thinking about how the capital that is flowing into certain asset classes in certain markets, those can be things that protect you, that also give you confidence in the markets or the assets that you're investing in. And the alternative, right, could be ways that you look otherwise, knowing that we're seeing some of the negative trends and demographics and interest in certain asset classes. So just paying attention to some of this data is going to be great for giving you the crystal ball, giving you the confidence that you're looking for to make the best data-driven decisions that you can. Now, as we look at May's data, which we'll continue to track here in the coming months, April's commercial real estate slowdown isn't a crisis. It is not a crash that everybody is claiming is going to happen. Yes, there's distress. Yes, there are challenges in the debt markets. Yes, there are things that overall with inflation, the economy, global risks that you need to factor in, but that ultimately is something that is going to be present pretty much at all times. It may just look a little bit different, and therefore you got to adjust accordingly. So, disciplined investors can find deals here. Some of the best investors I know are the ones who are most bullish in times like right now, when it is a buyer's market. So, is this something that you can take advantage of? Is this something that you are seeing out there? I'd love to hear your thoughts. If this helped clarify your strategy or overall, if you have any data, comments, thoughts that you want to add, drop those down below. Of course, if you enjoyed the video, hit that like button and subscribe to the channel. And if you are looking to go deeper, you want to be around other active commercial real estate investors, check out our Wise Investor Mastermind. We got all kinds of great tools and resources that are free down for you in the show description below. And if you want to know more about getting into our paid mastermind, you can learn more about that on the website at wiseinvestorcollective.com. With that being said, appreciate you as always for watching through the entire video. Until next one, we'll see you on the other side.